Okay, so you want to own a car wash. From the road, it looks almost unfairly simple. A driver pulls in, a machine sprays water, soap, wax, and air. 5 minutes later, the driver leaves, and another car takes its place. There is no inventory sitting on shelves, no dining room, no complicated menu. The customer does part of the work by driving the product through the building, and with an unlimited wash membership, money can arrive every month whether that customer visits once or 6 times. That is the version of the business you can see from the street. The version you would own is different. You would own the parcel that may or may not have the right entrance. You would own the queue that may or may not fit on the land. You would own the pumps, motors, sensors, dryers, payment terminals, chemical system, water reclaim equipment, and every hour of revenue they can stop producing. You would own the sewer approval, the stormwater rules, the customer damage claims, the labor schedule, the membership churn, and the loan payment that arrives even after 3 days of rain. And if you build a modern express tunnel, you may be committing several $1,000,000 before you know whether the neighborhood will give you enough paid volume to carry it. So this is not really a story about soap. It is a story about fixed costs, local demand, and one very expensive machine sitting on one very specific piece of land. By the end, we are going to compare 3 ways to enter the business, build 2 complete financial scenarios, and look at what happened when much larger operators discovered that recurring revenue does not make leverage disappear. Because the fastest tunnel in the world cannot rescue the wrong site. Before you ask what a car wash costs, you have to decide which car wash you are talking about. The first version is the smaller, self-service or in-bay automatic property. Think several open bays where customers use a wand, perhaps combined with one automatic machine that washes a stationary vehicle. This can be a relatively compact operation. It may need fewer people on site. But fewer employees does not mean no work. Someone still has to clean the bays, collect trash, refill chemicals, repair equipment, deal with freezing weather, answer customer complaints, and notice when a machine has stopped accepting payments. The second version is a flex or interior cleaning operation. The vehicle may move through an exterior wash, but employees add vacuuming, drying, wiping, detailing, or other interior services. That gives you more ways to increase the ticket. It also gives you more labor, more training, more quality control problems, and more opportunities for the customer experience to depend on the team working that shift. The third version is the modern express exterior tunnel. The owner is trying to move vehicles through a standardized process quickly, sell memberships aggressively, and keep direct interior cleaning labor out of the core service. The customer stays in the car. The tunnel does most of the visible work. Free vacuums may help attract and retain customers, but they also consume land and require maintenance. These formats can coexist under the same industry label while behaving like different companies. Mr. Car Wash illustrates the distinction at scale. At the end of 2025, it reported 485 express exterior locations and 63 locations that also offered employee-provided interior cleaning. The same brand was operating 2 different labor and service models. And the broader market is not made only of giant chains. The Census Bureau's 2023 County Business Patterns data counted 19,807 employer establishments classified as car washes. More than 10,000 of those establishments had fewer than 5 employees. That count excludes non-employer businesses and does not tell us which wash format each site used, but it shows how much of the market still consists of small establishments. As a potential owner, your first choice is therefore not between a good car wash and a bad car wash. It is between 3 operating systems. The smaller site can reduce the initial scale and staffing burden, but it may have lower revenue capacity and older equipment. The flex model can raise the ticket, but it turns labor management into a central competency. The express tunnel can create enormous throughput and a strong membership proposition, but it also raises the cost of the land, building, machinery, marketing, and ramp. Once the format changes, the price of entry changes by millions. You will often see a single number attached to the question, how much does it cost to open a car wash? That number is usually less useful than it appears. Does it include the land, the building, site work, sewer capacity, a turn lane, engineering, architecture, permits, the tunnel, vacuums, water reclaim, utility deposits, payment hardware, opening chemicals, pre-opening payroll, marketing, interest during construction, contingency, working capital for the months when the site is open but not yet busy? Two published franchise examples show how wide the answer can become even before geography is considered. A secondary summary of the 2025 Tommy's Express franchise disclosure document reported a total initial investment range of roughly $5 million to $8.5 million. A secondary summary of the 2025 Prime Car Wash disclosure reported roughly $1.9 million to $3.7 million for its flex service concept. Those are brand-specific ranges from secondary FDD summaries. They are not national averages, and they are not directly comparable. One concept, one parcel, one market, and one financing package can look nothing like another. Any investor would need the current disclosure document and project-specific bids before acting. But the ranges make one point very clearly. A car wash is not a single asset class with a single entry price. If you build, you take development risk. You can design the site for the operating model you want, install new equipment, and avoid inheriting someone else's deferred maintenance. In exchange, you carry entitlement risk, construction risk, cost overruns, and a period in which capital is committed but the site earns nothing. If you buy, you may get immediate customers, historical sales, existing utility connections, and a permitted use. But the revenue history has to be normalized. Was the prior owner underpricing? Were repairs deferred to improve the sale year numbers? Is the tunnel near the end of its useful life? Are memberships transferable? Does the property have a historical environmental condition? Mr. Car Wash itself warns in public filings about potential liabilities tied to legacy conditions at certain acquired or leased properties. That does not mean every older wash is contaminated. It means environmental diligence is not optional simply because the building already exists. Large portfolio deals are also dangerous comparison points. Driven Brands disclosed that 22 car wash acquisitions representing 35 sites cost about $350 million in aggregate in 2022. One 3-site portfolio cost $32 million. Those transactions may include real estate, geographic density, strategic value, membership bases, condition, and other factors that have little relationship to the wash for sale near your house. The owner question is not, what did someone else pay per site? It is, what am I receiving for every dollar and what cash must still be invested after closing? A cheap acquisition with a failing automatic, weak sewer connection, and no room for a queue can be more expensive than a higher-priced property with sound equipment and defensible access. And a beautiful new tunnel can become a $7 million monument to a bad traffic pattern. Imagine that a broker shows you a parcel on a busy commercial road. 50,000 cars pass it every day. There is a grocery store nearby. The demographics look strong. The traffic report is impressive. Now, drive the route as a customer. Can you see the entrance early enough to change lanes? Can you turn left across traffic? Can you enter from both directions? Does the center median block access? Will the queue back into the street? Can a pickup with a trailer navigate the approach? Is there enough room for pay stations, loading, the tunnel, dryers, vacuums, employee parking, and a safe exit without vehicles crossing each other? Traffic that cannot enter is not demand. The parcel has to perform 3 jobs at once. It has to be visible enough to create impulse visits. It has to be accessible enough to convert those visits, and it has to be large and correctly shaped enough to hold the queue that the business wants to generate. The exact rules are local. East Lansing, Michigan, for example, requires 15 stacking spaces per automatic conveyor bay, 6 per automatic rollover unit, and 3 per self-service or hand wash bay. That is one municipal example, not a national standard. But it shows why stacking is not a minor drawing detail. It can determine whether the use fits the parcel at all. An equipment manufacturer describes one express model as needing approximately 1 acre for a 130-foot tunnel, vacuums, and related operations. Again, that is a manufacturer model, not a universal requirement. Your jurisdiction may demand more setbacks, landscaping, stormwater storage, parking, or queue capacity. Your access design may consume land the brochure assumed was usable. Then there is competition. The market can be fragmented and still be saturated at the intersection that matters to you. You are not competing with the national industry average. You are competing with every convenient wash in the customer's normal driving pattern. The regional chain with 3 nearby locations, the gas station automatic, the older independent offering a lower price, and the new express tunnel already moving through planning. Mr. Car Wash warns investors that competition can force price reductions, service changes, and operating strategy changes. A single owner has even less room to absorb a local price war. Weather adds another layer. Road salt can create strong demand. Long dry periods may reduce urgency. Repeated rain can make customers postpone a wash. Freezing conditions can interfere with operations. These patterns affect not only annual volume, but also the timing of cash that has to cover payroll and debt. A serious site study, therefore, needs more than a traffic count. It needs turning movements, access, queue simulation, utility confirmation, competitor mapping, plan development, weather normalization, and a realistic estimate of how many drivers will choose this entrance at this price. The land is not the place where the business sits. The land is the business's first machine. Once the site works, the next question is how it earns money. The simplest revenue line is the retail wash. A customer arrives, chooses a package, pays once, and leaves. Higher packages may add waxes, protectants, wheel treatments, or other features. The challenge is volatility. Retail demand moves with weather, season, competition, and the customer's willingness to postpone a wash. Memberships change that rhythm. For a monthly fee, the customer can wash repeatedly under stated terms. The operator receives recurring revenue and gets a stronger chance of becoming the customer's default choice. A network can make the membership more valuable because the customer can use multiple locations. At the end of 2025, Mr. Car Wash reported about 2.3 million unlimited Wash Club members. Membership sales represented 76% of total wash sales. The company also estimated that its average member spent more than 4 times as much as its retail wash consumer. Driven Brands reported a similar strategic shift. Subscriptions represented about 69% of its domestic car wash revenue in 2024, up from about 60% the year before. Those numbers explain why nearly every modern express model talks about membership. But revenue is not contribution. One member may pay every month and visit once. Another may visit several times. A promotion may acquire members at a discount. A price increase may cause cancellations. A customer who joins because of a new site offer may leave when the offer ends. The membership count can rise while average realized revenue, usage cost, or retention moves in the wrong direction. So the useful owner metrics are not only total members and monthly recurring revenue. You also want new joins, cancellations, net member growth, price by cohort, visits per member, chemical and utility cost per visit, payment failures, promotional discounts, and the share of members who use the site during peak periods. Memberships can make cash flow more predictable. They cannot make a weak location strong, repair a broken conveyor, or eliminate labor and debt. Other revenue streams depend on format. A flex operation may sell interior cleaning and detailing. A smaller self-service site may earn from vending or ancillary equipment. Fleet accounts can add recurring volume, although they may come with lower pricing or concentrated credit risk. Vacuums may be free as part of the acquisition strategy or monetized separately. The owner has to understand why each dollar appears and what service obligation follows it. Because a membership is not a magical margin machine. It is a contract to keep the wash available whenever the customer decides to use it. This is where the brochure can become dangerous. One manufacturer describes an express model with approximate production capacity of 130 cars per hour. The same manufacturer says that the number is an estimate and that every project and tunnel is unique. That is the correct caveat, because physical capacity answers only one question. Under favorable operating conditions, how quickly can the system move vehicles? It does not tell you how many customers will arrive. Suppose a tunnel can theoretically process 130 cars in an hour. That does not mean it will process that number for 12 hours a day. Demand may be concentrated into Saturday morning and the first clear afternoon after a storm. Tuesday at 10 in the morning may be nearly empty. Then, loading speed matters. A driver hesitates at the conveyor. A pickup needs guidance. A payment lane backs up. An employee stops the line. A sensor faults. The dryers are not finishing vehicles cleanly, so staff slows production. The queue looks too long and drivers leave. Annual volume is the result of many smaller conversion steps. How many drivers see the site? How many can enter? How many accept the price? How many complete payment? How many can be loaded safely? How many are processed while the equipment is available? How many return? A wash can therefore have excess machine capacity and insufficient market demand. Or it can have strong demand at a few peaks and insufficient queue, labor, or uptime to capture it. This distinction matters because the fixed costs do not care about theoretical capacity. Property cost, insurance, management, software, and debt continue whether the tunnel processes 10 cars or 100 cars in the next hour. For your model, cars per hour should never be the revenue assumption by itself. Start with annual paid vehicles. Build that from realistic daily patterns, seasonality, weather, competition, opening hours, and downtime. Then check whether the equipment and queue can support the peaks. Capacity is the ceiling. Demand is what pays the loan. Now we can build the cost stack. Some costs move with each wash. Chemicals are consumed. Water and sewer charges increase. Electricity powers pumps, motors, blowers, lighting, and heating. Card processors take a fee. More visits from unlimited members still create service cost even though no new payment happens at the gate. Some costs move in steps. Labor may be low at quiet times and higher during peaks. An express tunnel may operate with a relatively small team compared with an interior cleaning model, but someone still has to load vehicles, assist customers, maintain the site, sell or explain memberships, and respond to problems. A flex operation can capture more service revenue, but every additional hand-performed task increases scheduling and quality risk. For context, the Bureau of Labor Statistics reported a national mean wage of $17.78 per hour for cleaners of vehicles and equipment in May 2025, with a median of $17.23. That occupation is broader than car washes, and local wages can be very different. It also does not represent manager, mechanic, or technician pay. But it is a reminder that a labor-heavy wash cannot be modeled with yesterday's wage assumptions. Then there are fixed and semi-fixed costs: property tax or rent, insurance, software, internet, security, landscaping, snow removal where relevant, trash, bookkeeping, licenses, marketing, and management. Repairs sit awkwardly between categories. You know they will happen, you do not know exactly when. The same is true of customer damage claims. A mirror, antenna, loose trim piece, wheel, or prior vehicle defect can become a dispute at the exit. Good procedures, cameras, signage, training, and insurance reduce risk, but they do not make it disappear. Public company numbers show the importance of the full stack, although they should not be copied into a single-site model. In 2025, Mr. Car Wash reported labor and chemicals equal to 29% of net revenue. Other store operating expenses equaled 42%. In the first quarter of 2026, those categories were 28% and 41%, respectively. Those are chain-level accounting categories from a large operator. They include a format mix, scale, leases, and cost structures that may be very different from yours. They are not a promise that your site will produce the remaining percentage. But they destroy the idea that revenue falls almost directly to the bottom line after soap and water. The owner needs 3 layers in the model. First, contribution per retail wash and per member visit. Second, site operating cash before financing and capital replacement. Third, actual owner cash after maintenance capital, interest, and principal. If you stop at the first or second layer, the business will look much richer than the bank account. At 7 in the morning, before a strong Saturday, the site manager hears a sound that was not there yesterday. A motor is struggling, a pump is losing pressure, a sensor is misreading a vehicle, the pay station will not connect, a chemical injector is not delivering correctly, the reclaim system is alarming, the conveyor stops. This is the moment when low labor can become no revenue. A car wash is a chain of dependent systems. The customer cannot buy half a tunnel. If one critical component prevents safe operation, the entire line may stop. The direct cost is the part and the technician. The larger cost may be the queue that drives away, the members who find the site closed, the refunds, the social media complaints, and the retail customers who form a new habit at the competitor down the road. Preventive maintenance is therefore not simply a repair budget. It is revenue protection. The owner needs inspection routines, spare parts for predictable failures, reliable technical support, chemical monitoring, water system maintenance, freeze procedures where relevant, and authority for the manager to stop the line before a small issue becomes vehicle damage. And the financial model needs a maintenance capital reserve. Mr. Car Wash reported $28.5 million of maintenance capital expenditures in 2025, alongside much larger growth capital spending. Again, that company-wide number cannot tell you what one site should reserve. What it demonstrates is that a mature car wash system still requires capital after the original construction check is written. This is also why EBITDA can mislead an owner. Mr. Car Wash explicitly tells investors that adjusted EBITDA does not reflect capital expenditures, working capital needs, interest or principal payments, or replacement of depreciating assets. If a seller shows you an attractive operating margin, ask what was spent on replacement equipment during the last 5 years. Then ask what should have been spent but was postponed. A tunnel can report earnings while quietly accumulating a future repair bill. Most beginners start the water conversation by asking what water costs per car. The earlier question is whether the site can legally receive, route, treat, reuse, and discharge it. The Environmental Protection Agency says commercial car washes are required to dispose of wastewater properly, and that many filter and recycle water. But the operational details are not controlled by one simple national rule. They are layered. There may be federal environmental requirements, state water rules, municipal sewer conditions, stormwater rules, plumbing and building codes, and drought restrictions. The answer can change from one city to the next. California provides one state-level example. Qualifying in-bay and conveyor washes permitted and built after January 1, 2014 must recycle and reuse at least 60% of wash and rinse water, or use supplier-provided recycled water for at least 60%. Self-service washes are exempt from that specific law, and local governments may adopt stricter requirements. San Antonio provides a local stormwater example. Its guidance directs commercial fleet washing to special pads that capture wash water and discharge it safely to the sanitary sewer, rather than the storm drain system. Bremerton, Washington gives another local example. Commercial and fleet vehicle washing should occur in a designated paved area connected to the sanitary sewer or a closed-loop recycling system. These examples do not create one nationwide checklist. They show why your engineer and local utility need to answer the question in writing for your parcel. The design can affect both capital cost and operations. A reclaim system needs space, tanks, pumps, filtration, controls, maintenance, and trained attention. Sewer capacity may limit the project. Stormwater design may consume land. A drought can create restrictions or public pressure, even when the site has complied with ordinary rules. Mr. Car Wash lists drought, natural hazards, government restrictions, and local water system interruptions among risks that can reduce access to water and hurt operations. If you are acquiring an older property, the environmental review also needs to look backward. Historical use, underground systems, chemical handling, and prior site conditions may create liabilities that are not visible in the seller's income statement. So water is not merely a variable cost line. It is part of the entitlement, engineering, maintenance, and continuity plan. And if the sewer authority says no, your revenue forecast is zero. A car wash can be operationally profitable and financially fragile at the same time. The difference is leverage. Suppose a site produces strong earnings before interest, taxes, depreciation, and amortization. That sounds reassuring, but the owner does not spend EBITDA. The owner spends cash left after equipment replacement, working capital, interest, principal, taxes, and whatever the business needs to survive the next week, month. Mr. Car Wash reported an adjusted EBITDA margin of 32.8% in 2025, while its net income margin was 9.8%. Those measures answer different questions. The company's own filing explains that adjusted EBITDA excludes capital spending, working capital needs, debt payments, and replacement of depreciating assets. For a single-site buyer, that distinction can determine whether the deal is survivable. Financing may come from conventional lenders, investors, seller financing, or SBA-backed structures. The SBA's 7A program currently allows loans up to $5 million and can support real estate, buildings, working capital, machinery and equipment, refinancing, and complete or partial changes of ownership, subject to eligibility and lender approval. The 504 program provides long-term fixed-rate financing for major fixed assets with a maximum SBA loan amount of $5.5 million, again subject to eligibility and the full financing structure. Effective July 4, 2026, qualified borrowers may combine up to $5 million of 7A financing with up to $5 million of 504 financing for as much as $10 million in SBA-backed financing. That does not mean every project qualifies. It does not mean a lender will approve the maximum, and it certainly does not mean maximum leverage is wise. Debt creates a fixed claim on a variable business. Rain can reduce retail traffic. A competitor can discount. Construction can finish late. Memberships can ramp slowly. Equipment can stop. But the monthly payment remains scheduled. The owner therefore needs to model not only the stabilized year, but also the path to it. How much cash is available after the down payment? How much working capital is reserved? What happens if opening is delayed? What happens if volume is 20% below plan? What happens if the interest rate is higher at closing? What happens if a major component needs replacement in year 2? The strongest deal is not necessarily the one that produces the highest projected return. It may be the one that can survive being wrong. Let us build the first owner model. Everything in this scenario is illustrative. These are not industry averages, not an appraisal, and not a forecast for a real property. Assume you are buying an older 4-bay self-service wash with one in-bay automatic for $1,250,000. The price includes the real estate and operating assets. You invest 25% equity, $312,500. You borrow $937,500 for 20 years at 8.5%. That produces a monthly principal and interest payment of about $8,100, or approximately $97,600 per year. Your real cash requirement would likely be higher than the down payment because you still need diligence, closing costs, initial repairs, and working capital. We will keep those outside the operating model so that the annual math remains visible. Now assume the site completes 50,000 paid transactions in a mature year at an average realized ticket of $12.50. That creates $625,000 of wash revenue. Add $25,000 from vending, fleet activity, and other ancillary sales. Total revenue becomes $650,000. Assume variable operating costs equal 18% of revenue, or $117,000. This is simply a model input covering utilities, chemicals, and transaction-linked costs. It is not a sourced industry benchmark. Budget $135,000 for payroll and management coverage. Budget another $170,000 for property tax, insurance, routine repairs, software, marketing, cleaning, professional fees, and other fixed operating costs. Then reserve $45,000 for maintenance capital. After those assumptions, the site produces $183,000 before debt service. After approximately $97,600 of annual loan payments, pre-tax cash is about $85,400. That may look reasonable against the initial equity check, but it is not passive. It is before income tax. It assumes the equipment condition supports the maintenance reserve. It assumes the revenue history is real. It assumes no extraordinary repair, and it assumes the owner has already funded the working capital needed to absorb volatility. Now reduce volume by 15%. Revenue falls from $650,000 to $552,500. Variable cost falls with it to about $99,500. But payroll, fixed operating costs, the maintenance reserve, and debt do not fall just because fewer cars arrive. Annual debt service, about $97,600. Pre-tax cash after debt, about $5,400. The annual cash after debt falls to roughly $5,400. One repair, one insurance increase, or 1 month of disrupted operation can push it negative. Under these assumptions, the site needs roughly $546,000 of annual revenue just to cover the modeled variable costs, payroll, fixed operating costs, maintenance reserve, and debt. That is the lesson of the smaller acquisition. The price may be lower than a new tunnel, but the owner still has a fixed cost machine. If the equipment is old, the maintenance reserve is not optional. If management is omitted from the model, the profit may simply be unpaid owner labor. If the down payment consumes all available cash, a modest volume miss can become a liquidity problem. The smaller wash is not automatically safer. It is safer only when the purchase price, equipment condition, real paid volume, and capital structure leave room for error. Now move to the other end of the spectrum. Again, every number in this scenario is an illustrative assumption. It is not a quote from a manufacturer, a franchise forecast, or an expected result for any named brand. Assume an all-in Greenfield Express project costs $7 million. That sits inside the broad brand-specific range we discussed earlier, but the $7 million figure is chosen for this model alone. You invest 30% equity, $2,100,000. You borrow $4,900,000 for 20 years at 8%. The principal and interest payment is about $41,000 per month, or approximately $491,800 per year. That payment begins long before the site becomes mature. First, let us build the stabilized case. Assume the wash reaches 3,500 members, paying an average of $28 per month. Membership revenue is $1,176,000 per year. Assume another 90,000 retail washes at an average realized ticket of $17. Retail revenue is $1,530,000. Total modeled revenue is $2,706,000. Pre-tax cash after reserve and debt, about $330,300. For simplicity, assume site operating costs consume 65% of revenue. That leaves operating earnings of approximately $947,100. Reserve $125,000 for maintenance capital. After that reserve and annual debt service, pre-tax cash is approximately $330,300. On paper, the mature project works, but the owner does not open on the mature day. Mr. Car Wash says its own greenfield locations typically require approximately 3 full years to mature to average unit volumes. That is a company-specific statement, not a rule for every project. But it is exactly the kind of ramp risk a new owner must take seriously. So, build a ramp. Year case. Assume 2,000 members at the same $28 monthly price. That creates $672,000 of annual membership revenue. Assume 65,000 retail washes at $17. That creates $1,105,000 of retail revenue. Total revenue is $1,777,000. In a ramp year, marketing, opening inefficiency, staffing, and fixed site costs may consume a larger share of revenue. For this illustration, assume operating costs equal 75%. Operating costs at modeled 75%, $1,332,750. Operating earnings, $444,250. Maintenance capital reserve, $100,000. Annual debt service, about $491,800. Pre-tax cash after reserve and debt, negative about $147,600. Operating earnings are about $444,250. Reserve $100,000 for maintenance capital, then pay roughly $491,800 of debt service. The result is a pre-tax cash deficit of about $147,600. The same project that produces more than $330,000 in the mature model consumes almost $150,000 in the ramp model. And that is before a construction overrun, delayed opening, tax, or extraordinary failure. The owner's $2.1 million equity contribution is therefore not the complete liquidity plan. A lender may require reserves. The project may need additional working capital. If the owner assumes the stabilized membership count will appear within months, the business can run out of cash while the underlying site is still developing normally. This is why membership sales strategy matters so much after opening. The team has to convert retail customers, retain members, manage promotions, and keep the site available. But discounting memberships to accelerate the count can reduce realized revenue. Heavy users add visits. A nearby competitor can open during the ramp. Weather can distort early results. The express tunnel offers a much higher ceiling than the smaller property. It also places more capital below a revenue curve that may take years to arrive. At this point, the two scenarios may sound conservative. The industry has already produced larger examples of why they need to be. Driven Brands expanded aggressively in car washing. In 2022, it completed 22 acquisitions, representing 35 sites for about $350 million in aggregate. Then, the story changed. After a strategic review, the company approved the closure of 29 car wash stores and halted new company-operated openings. It recorded $122 million of impairments related to property, held-for-sale assets, and leases associated with the closures. In 2023, Driven recorded an $851 million goodwill impairment directly attributable to its car wash segment. Goodwill impairment is an accounting charge, not the same thing as losing that amount of cash in one moment, but it signals that the assessed value of prior expectations had fallen dramatically. In 2024, the company recorded another $325 million of impairment on U.S. car wash property and equipment. The operating numbers were under pressure as well. Car wash same-store sales declined 0.9% in 2024. Segment-adjusted EBITDA was about $117 million, and the adjusted EBITDA margin fell to 19.9% from 21.4%. Subscriptions still represented roughly 69% of domestic car wash revenue. Recurring revenue was present. It did not eliminate competition, labor, site performance, asset values, or strategic risk. In April 2025, Driven completed the sale of its U.S. car wash business for aggregate consideration of $385 million, including cash and a seller note. That does not prove that every acquisition was bad or that one cause explains the outcome. It does show how quickly a growth narrative can reverse when expected site economics do not survive reality. Zips Car Wash provides an even sharper leverage example. According to Reuters reporting based on bankruptcy court documents, Zips filed for Chapter 11 protection on February 5, 2025, with approximately $654 million of funded debt and about $1 million of cash. At the time, it operated more than 260 washes across 23 states, employed about 1,800 people, washed roughly 24 million cars annually, and generated approximately $303 million of trailing revenue. Those are not the numbers of a business with no customers. The company attributed pressure to rising interest rates, higher labor costs, increased competition, and a rapidly expanded footprint. That is the company's account reported from the court process, not proof that any single factor caused the filing. Zips was not liquidated. Its reorganization plan was confirmed in April, and it emerged from Chapter 11 on April 30, 2025, after reducing debt and restructuring ownership. The owner lesson is not that scale is bad or that membership is fake. It is that leverage converts operating disappointments into financial emergencies. A site can wash millions of cars. A chain can collect recurring revenue. The business can still become insolvent if debt, interest, labor, competition, and expansion consume the margin for error. For a single site owner, the same mechanism arrives in smaller numbers and with fewer escape routes. A national operator can sell assets, renegotiate capital, or restructure a portfolio. An individual owner may have one property, one lender, and a personal guarantee. That is why diligence has to be designed around failure, not optimism. Before you commit equity, ask 10 questions that require evidence rather than a sales answer. First, what is the normalized paid car count? Do not accept one strong year. Review several years by month. Separate members from retail visits. Adjust for weather, closures, price changes, promotions, and unusual local events. Second, what do the membership cohorts actually do? How many join, cancel, fail payment, return, and visit? What price is each cohort paying? How much of the reported count came from temporary promotions? Third, which competitors affect this exact driving pattern? Map existing washes, planned developments, gas station automatics, and the routes customers use. A competitor 3 miles away may be irrelevant across a barrier or devastating on the same commute. Fourth, can customers enter and queue legally? Obtain the access plan, traffic conditions, stacking requirement, and turning analysis. Drive the site at peak times. Do not assume a high traffic count becomes usable volume. Fifth, what has the Sewer and Stormwater Authority approved? Get written answers. Confirm discharge requirements, capacity, pretreatment, reclaim expectations, sampling, fees, and any drought or water use conditions that can affect operations. Sixth, what equipment will need replacement? Inspect the tunnel or automatic with someone who understands the system. Review maintenance records, downtime, parts availability, service contracts, and deferred repairs. Build a replacement schedule instead of one generic repair percentage. Seventh, what happens during a critical failure? Who answers the phone? How quickly can a technician arrive? Which parts are on site? Can one bay continue operating? How are members notified and retained? Eighth, what do claims and insurance history reveal? Review customer damage claims, workers' compensation, property coverage, deductibles, exclusions, and premium history. A clean income statement can hide operational sloppiness in a claims file. Ninth, who is actually running the wash? If the current owner works 60 hours a week, replace that labor in the model. If one manager holds all the knowledge, plan for turnover. If the concept requires 3 to 6 employees per shift pattern or site model, verify the local labor supply and wage. 10th, does the deal survive a bad version of the future? Run lower volume, slower membership growth, higher wages, higher insurance, delayed opening, extra maintenance, and the actual debt payment. Then combine several of them. Real problems rarely arrive one at a time. For an acquisition, add environmental review, title, zoning confirmation, lease analysis where applicable, tax history, and verification that every permit remains valid after a change of ownership. The goal is not to prove that the wash will fail. The goal is to discover which assumption has to be perfect for it to succeed. If the answer is 3 or 4 assumptions, the price or capital structure has to change. So, should you own one? The smaller self-service or in-bay property may fit an owner who can evaluate older equipment, tolerate hands-on maintenance, and buy with conservative debt. It can offer a more manageable entry point, but it may also be a job disguised as an investment if the model excludes the owner's time. The flex or interior cleaning operation may fit someone with stronger labor and service management skills. The higher ticket can be attractive, so can detailing and interior revenue. But the product is no longer only the machine. It is the performance of the people on every shift. The express tunnel may fit an owner or group with development experience, substantial capital, disciplined marketing, data systems, maintenance capability, and enough liquidity to survive the ramp. It can create a powerful membership business and high vehicle capacity. It can also place millions of dollars behind one traffic pattern and one local competitive market. Across all 3 formats, 6 variables dominate the decision. 1. Is the use legally permitted and physically workable on the parcel? 2. How many paid vehicles will actually arrive over a normalized year? 3. What contribution does each retail customer and member create after usage cost and discounts? 4. How reliably can the equipment remain available during peak demand? 5. How much maintenance capital and management labor does the model really require? 6. Can the balance sheet survive the ramp, a volume miss, and an unexpected repair at the same time? If those answers are strong, a car wash can become a durable local business with recurring customer relationships and a valuable operating site. If those answers are weak, faster equipment and prettier branding only make the mistake more expensive. The customer experiences 5 minutes of soap, brushes, water, and air. You experience years of land, permits, construction, staffing, maintenance, customer acquisition, and debt. That is what you are buying. Not soap, a regulated throughput system, and the system only works when every constraint works together.